Hi, my name is Dan Mclaughlin. You can find my economic analysis generally on www.danmclaughlin.ie. For this PowerPoint presentation, I'm going to have a look at the Irish housing market as it stands as mid-August 2014. The scale of the house price collapse in Ireland was quite astonishing, one of the largest falls ever seen in a Western developed economy. Nominal prices fell by 50% in Ireland from 2007 onwards, and by nearly 60% in Dublin, the capital. In cash terms, that means that in Dublin, for example, prices got up to around 450,000 euros and ended up below 200,000 euros, whereas nationally prices peaked around 330,000 euros and ended up around 160,000 euros at the bottom. The market does seem to have bottomed though. Prices started to turn positive around the spring of 2013, and over the last 15 months or so we've seen fairly steady price increases. So the annual change in house prices nationally as of June 2014 was 12.5%. Those strong gains in house prices nationally do mask a divergent performance across the country though, and in particular house prices in Dublin are rising much more rapidly than elsewhere. And we can see that from this chart, which shows you annual house price inflation in Dublin running at 24% in June, whereas across the rest of the country annual house price inflation is running at only 3.5%. So house prices have picked up elsewhere, but clearly not at the pace that we're seeing in the capital. Indeed, the fact that house prices have begun to pick up and have risen quite sharply in Dublin, of course, over the past 15 months or so, has prompted some to talk about a bubble emerging again. Although I think if one looks at house prices relative to a number of standard fundamental metrics, we can probably say that house prices fell too far in the downturn and still look relatively good value against those fundamentals. We have three here in this table which I think are of interest. The first is affordability, by which we mean the cost of a new mortgage relative to income. So that takes account of interest rates, which are obviously very low, and also is benefiting from the fact that the average new mortgage in Ireland has fallen very substantially given the house price declines since 2007. So on that basis, we can see that if you take the long run average in terms of affordability back to 1975, that house prices are around 17% below fair value, one might say. In terms of rents as well, which have risen quite strongly, of course, in the last couple of years, but still, if we look at the ratio of house prices to rents going back to 1996, again, house prices are around 19% below the long-run average. And the third thing we can look at is house prices relative to income. And again, going way back to 1975, if we take the long-run average over that period to 2013, house prices are around 17% below the long-run average. So in all the kind of metrics that we can look at, and this conclusion has also been reiterated by the SRI and the central bank in their research, on those kind of standard metrics, house prices certainly don't look overvalued. I think the rental market is a good indicator of the underlying demand and supply balance for housing. And in this chart, we can look at the annual change in national rents as measured by the CSO in Ireland. You can see clearly that rents have been rising now for around 3 years, implying a tightening of that demand-supply balance for housing. And indeed, in the early months of 2014, we were seeing 10% year-over-year growth in average private sector rents. That pace has slowed a little bit in the last few months, but it's still fairly robust. So clearly that does imply that the market has tightened somewhat over the last couple of years. That increase in rents that's been very evident in Ireland for the last couple of years obviously will prompt some households to try and look to buy their own property and therefore seek a mortgage. And in this chart, we revisit that affordability metric I was talking about earlier. Just to be clear what this means, we're looking at a 25-year repayment mortgage. How much does it cost in the first year relative to income? So it's obviously affected by interest rates, but also particularly the fact that the average new mortgage right now is a lot lower than it was a few years ago. And this looks at that metric going back to 1975. As you can see very clearly, affordability deteriorated very rapidly from around 2004, 2005. By 2007, was at very much extreme levels. In other words, the cost of an average new mortgage relative to income was extremely high, and that ultimately was a factor in precipitating the very significant correction in the market. But also we can see now that affordability has improved very substantially over the last few years. The cost of an average new mortgage relative to income is now well below the long-run average. And indeed, from the chart, you can see it's back to levels we last saw in the late 1990s. So in terms of affordability, one would certainly expect to see some pickup in mortgage demand. Mortgage and indeed housing demand is largely determined by the movement of household income, which in turn will be affected by wages and particularly employment. And so in that sense, again, developments of late would tend to be supportive of the housing market and the demand for mortgages. In this chart, we have a look at the Irish economy and employment over the last 6 or 7 years. And you can see that GDP peaked towards the end of 2007 and dropped something of the order of 12%. And we have seen a recovery, but particularly in the first few years, it has been very uneven and very weak. But latterly, the economy has picked up a bit of momentum. And in the first quarter of the year, GDP was up over 4% on the previous year. So the economy does seem to be getting a little more traction now. But also, I think, more importantly, particularly for the housing market, is that employment has started to grow and indeed grow quite strongly. Again, if you look at the chart, we've rebased the employment figure back to, again, the fourth quarter of 2007. And during the downturn, employment fell more rapidly than GDP, a huge number of job losses, particularly in certain industries like construction. And indeed, employment fell overall by 15%. But as you can see, it also bottomed out around the end of 2012, and over the last year or so has been rising by over 50,000 or just under 3% year over year. So the broader economic backdrop is also, I think, more supportive of mortgage demand. As we've seen, house prices are rising, and we'll say that it seems fairly clear now that we are in some kind of recovery mode in the market. But in certain other areas, we can see that we're very far from a normal market. If we look at transactions, for example, according to the Property Price Register in 2013, there was around 30,000 property transactions residential property transactions in Ireland. And in a normal market, one might expect that to be at least 60,000. So we're well off, well away from what one considered to be an equilibrium there. And also, I think the interesting thing about the transactions is how many of them are being conducted, it would seem, through cash rather than credit. In this chart, I've shown the quarterly trend in transactions and also the new mortgage loans that are drawn down in each quarter. And in fact, it's still the case that on that basis, new mortgage loans seem to be accounting for less than 50% of total transactions. Again, implying kind of quite an abnormal market. One would generally believe that perhaps 80, even 85% of transactions would normally be done on credit via mortgages. but therefore a sub 50% ratio, as we're seeing of late, would still imply the market is being driven by relative lack of supply and largely being driven by cash buyers at the moment. Mortgage lending is beginning to pick up, though, it has to be said. To put it in context, though, from extraordinarily low levels, at the peak of the boom, for example, there was around 110,000 new mortgage loans for house purchase, and at the bottom of the cycle in 2011, that figure had fallen to just 11,000. We have seen a little bit of a pickup, though, in the last, particularly I think in the last 18 months or so, and in particular in the first half of 2014, we're beginning to see very strong year-over-year growth in new mortgage loans. So I think for 2014 as a whole, we'll probably see something of the order of 16,000, which would be well up on the sub 14,000 figure we saw in 2013. But again, in a normal market, one would expect a very significantly higher figure than that. So although mortgage lending is picking up, it is from abnormally low levels. Irish households already have a huge amount of debt, however, and consequently I think that will be a constraint in terms of the pace of further debt accumulation. The scale of that debt is clear, I think, from this chart. What we're trying to show here is the total amount of household debt, which is the blue line on the left-hand scale, and also the debt relative to household disposable income, which is the orange line relative on the right-hand scale. And on both metrics, you can see that through the noughties, debt accumulation was very rapid. Total debt actually got up to 200 billion by the middle of 2008. And over the last 4 years or so, there's been a very significant deleveraging. In fact, total household debt has fallen by something of the order of 35 billion. We've also seen household debt relative to disposable income decline, but the pace of that decline has been much more modest, simply because the denominator, household disposable income, has also been falling generally, although it looks now as if it's begun to stabilize. So consequently, the debt burden has fallen, but not as rapidly as one would have hoped, simply because disposable income has also been under pressure. But what is clear is that that pace of deleveraging has been very rapid in general, in absolute terms, and I think that's had a huge influence on the economy in general. I think most forecasters have been expecting household consumer spending to have strengthened much more than it has. I think what everyone has underestimated is the impact of that deleveraging. Households simply want to reduce their debt burdens and are therefore curbing expenditure. When that comes to an end is very difficult to say, and as long as it continues, it's also obviously going to have a significant impact in terms of willingness of households to incur further debt. So if we put those two last two slides together, if you like, we can see that new mortgage lending is picking up, but we're also seeing very substantial mortgage debt repayment. So consequently, the outstanding amount of mortgage debt is actually declining. So net mortgage lending is contracting. And we see the annual change in net mortgage lending in this chart here. And you can see it turn negative around the summer of 2010 and has been contracting ever since, and the latest figure is minus 3.1 in June. So consequently, we can say that net mortgage lending has been contracting now for 4 years, which obviously has a significant impact in terms of the economy, but particularly for the Irish banking sector, where we're seeing total loans for Irish banks that are still falling. What about the supply of housing? Well, in this chart we look at Irish house completions, in other words, how much house building has been going on, and you can see again visually the startling collapse in Irish house building that occurred from 2006. At that time, there was over 90,000 new completions in the economy, but by 2012 and 2013, we'd got down to well under 10,000. Now looks as if though the market bottomed around 2013, where there was around 8,300 completions, and 2014 does look as if it'll be stronger. We think probably a little bit under 10,000 completions. So again, showing signs of a bottoming out, but certainly completions by historic standards extraordinarily low. I think the limited number of house completions that we're seeing has had a particular impact on the Dublin market. Here we have the level of house completions in Dublin in recent years in terms of the city itself and the county, and you can see that in general it's been between 1,000 and 1,500 a year. I've also included 2014. We've only got 5 months, so I've annualized the 5 months data, so there is a little bit of a pickup, but it's still pretty low. And also what I've also included is the actual number of houses as opposed to apartments, and you can see that's in general been well below 1,000. So how many housing units does Dublin need? And again, that depends on predictions about total population growth, which are very dependent on one's assumptions about, particularly about migration. But again, if one looks at a number of studies in the last year or so from the ESRI, from the Housing Agency, they're all fairly consistent in showing that Dublin probably needs, over the next 7 or 8 years, 7,500 units on average a year. So on that basis, you can see that the amount of supply or new supply coming onto the market in terms of house build is way short of that. So the implication, I think, is pretty clear that in the absence of a significant demand shock, there is very clearly a excess demand for housing in the capital, and therefore one is likely to see further house price appreciation in Dublin. So in summary, I think we can say that the Irish housing market probably overshot on the downside and bottomed out eventually around I think the spring of 2013. And as we move through 2014, seems to be gaining momentum, judging by a range of indicators. House prices outside Dublin are beginning to rise now. They've obviously been rising for some time now and at a pretty rapid clip in the capital. But rents, I think, nationally have also been rising strongly for some time. House building is picking up finally, and also new mortgage lending is also rising. That said, I think it's pretty clear that the market is still illiquid and very far from normal levels. Transactions are rising, but still remain very low. And also a very unusual feature is the fact that less than half of transactions seem to be funded by credit, which is not sustainable, I think, into the medium term. I think where the market goes from here, I think, is very dependent on situation. Across the country, there are obviously areas where there's a fair amount of vacant supply, and that's likely to dampen down any price pressure. But I think in the main cities, absence a demand shock, which is always possible, of course, but absent such a shock, we're likely to see some modest price appreciation. I think the situation in Dublin, though, is clearly very different. Seems to be a pretty blatant mismatch between housing demand and housing supply. And housing supply is unlikely, I think, to rise rapidly in the next few years. So on that basis, one could see house prices in Dublin continue to rise at a fairly steady clip. So that's it. We've come to the end of our review of the Irish housing market. Hope you've enjoyed it. If you'd like to look at any more research on the Irish economy or on financial markets generally, have a look at www.danmclaughlin.ie, our website, or also you can follow me on Twitter at Dr. Dan Mclaughlin. Thanks very much for your attention.